What's going on, YouTube? CJ here with the Trading Collective, an education-based community of traders. Today we're going to be going over a basic options class, and I'm going to be showing you guys kind of what options are and how to trade them. Level 1, and yeah, we're going to dive right into it. So if you look in the description of this video, you'll see a link to our website where we have the handout. This is what that looks like. You'll give that a click, and boom, here's your handout. Now, before we dive into it, if you guys wouldn't mind smashing that like button and subscribing if you're not already, we appreciate it a whole lot. It helps us stay motivated for what it is that we're doing and trying to do and facilitate for you guys. Now, the goal of this video is to deliver it in a very timely manner, not overwhelm you guys with information you don't need to be able to get into options trading, or be able to follow along with us on our daily live streams in the Discord or in our Facebook. Anyways, we'll dive right into it. What options are, what a call is. So a call is the right to buy 100 shares of the underlying security at that strike price. And a put is a right to sell 100 shares of that underlying security at that strike price. So that would mean a call is a bullish position and a put is a bearish position. What premium is? Premium is the amount that you pay for that contract, for that options contract, whether it's a call or a put. That is how much you pay for it. The bid-ask spread, that is the amount from the highest point that somebody's wanting to buy to the highest point that somebody's wanting to sell, or the lowest point that somebody's wanting to sell. Highest point, yeah, highest point they're wanting to sell and the lowest point they're wanting to buy. There we go. That is the bid-ask spread. And then the delta and theta, the Greeks. There are other Greeks, but for options level 1, you only need to concern yourself with the delta and the theta. Delta is the amount that you can expect your contract to increase with every $1 shift in your favor, and the theta is the time decay for your contract. So the closer to expiration, the more your contract will become worthless if it's out of the money, especially. And then implied volatility. So I actually have pulled up here a good description for implied volatility, because I could spend probably 20 minutes on this alone. So options that have high levels of implied volatility will result in high price option premiums. Conversely, when the market expectations decreases or demand for an option diminishes, like the implied volatility will decrease. Pretty much what that means is IV can help you or it can hurt you. If it starts to hurt you, we call that IV crush. So if the security is consolidating or tanking, then the IV for weeklies or 0-day contracts can really start to hurt. And I'll show you guys in Webull what all of these look like. So we'll flip over to Webull. So we're seeing the whole options table right here, and we're seeing, the $10 strike right here. This is the strike. This is the call side. You see calls up here, puts over here, put side. We're seeing the bid and the ask for that strike. You're seeing the implied volatility right here, and you're seeing our delta and our theta. If you guys want to adjust any of the settings, click that little hamburger menu right there. You can add or remove whatever it is that you'd like. We'll get into open interest and volume here in just a moment, and we'll also get into actually buying, and that will be section 2, how to trade them, how to trade options with Webull, PDT avoidance, cash accounts. So most retail traders and brokerages require you to have $25,000 or more. Otherwise, if you buy and sell something within the same day, that's a day trading pattern, and you can't do that. So I think it's 4. If you do 4 within a 5-day period, you get flagged as a day trader and your account is locked. But with Webull, the reason I like Webull so much is there's a very easy way to sidestep the PDT rule, and that's using a cash account. There'll be a sign up link for Webull in the description of this if you'd like to get started. I think it's a very easy, there's also TOS and Fidelity and Charles Schwab and all these other. I just personally like Webull. But yeah, so when you have a cash account, you can buy and sell an options contract or a stock with settled cash in the same day. So that's the only thing that you have to worry about is how much settled funds you have. Now, funds for options settle overnight, actually, in the pre-market. And then for stocks, it takes about 2 to 3 days for that money to settle. So just keep that in mind. And then now we're going to start getting into how to select a viable options contract. We'll be talking about OI or open interest, closer to the money, and expiration. So I'll actually start with the kind of terminology. So there's in the money, at the money, and out of the money. So the money is the current price for the security. For FSEL, we're seeing that current price at 827. So in the money contract would be the first, let's say for the call side, would be the first contract under that amount. So that would be the $8 strike right here. That is in the money. Now out of the money would be the 850 or anything above that. Would be out of the money. Now, if this had smacked right on 850, that would be at the money. But in the money is everything below the $8 contract, and then out of the money is everything above the 850 contract. And yeah, so now we'll talk about open interest. So the higher the open interest, the more faith that the market seems to have with that price for that security. But that's not the only reason you should take that position. You just want to be looking at a good high open interest because you know that you shouldn't have too tough of a time like selling or buying into that position. You can also check your volume right next to it as well. So I actually use a great example here for Twitter. This is something we talked about in our Discord the other day. So we'll look at the June 18th week for Twitter. And I said there's an unusual amount of open interest. So you're seeing like right here, the $70 strike. This would almost be a whale alert. There's over 30,000 open interest on this $70 strike for June 18th. That's kind of crazy. You're seeing 16,000 at 65. You're seeing 18,000 at 60. Just a whole lot of volume. Now, if we just go the week prior, we'll go to those same contracts. The open interest is nowhere near it. So we wouldn't want to trade this week if we were swing trading. Now, when it comes to when you're selecting what contract you want, there's 3 different types of trading. Well, some people will say there's only 2. I say there's 3. There's scalping, meaning you're in and out of position in maybe just a few seconds or a couple minutes. There's day trading, which is, in and out of position in the same day. Some people like to group those together. And then there's swinging. Swinging is longer term, potentially excess of months. Now, for me, I'm mostly a scalper. Day trader, so I'll play week contracts or weeklies. So I'll go to the contract that's most available or the closest contract expiration. So go back to the handout here. That covers open interest, closer to the money. So you want to be closer to the money, because the closer you are to the money, the quicker you'll be making money. So keep that in mind. If I were to be wanting to play this for this week, if I actually wanted to play this, I would probably grow. Or let's use Twitter for an example here. If I was looking for a Twitter weekly to play, because I'm bullish on Twitter for tomorrow, I'd probably go grab a Twitter Twitter 55. Look at that. Right here, 12,808 open interests. Shouldn't have any issue getting this contract filled considering our volume. It's 3,200. These contracts right around the 54.50 and the 55.50 strike, way lower volume. We might have a tougher time getting filled. We also want to make sure that we have a nice spread. We'll talk about that in just a moment as well. Essentially, you don't want to get into a contract or try to get in, or force yourself in a position with something that has an astronomical bid-ask spread. So if the bid-ask spread for this Twitter contract was, let's say the ask was at 70 cents and the bid was at 5 cents, I would not even think about touching that. That's way too big of a spread for me personally. But some people might be comfortable with that. Not what I look for at all. Buying, not selling a contract. This is a very, very, very easy way to screw your account up if you're clicking the wrong thing. So when you're buying a contract, you're buying it. So you're not selling a contract. There is a big difference. That's a more advanced version of options trading. We'll talk about that later. But when you click on the contract, click on last price or ask. Make sure it says buy over here. Adjust your limit and then place your order. And then when you're ready to sell, what you're really doing is closing your position. So you can right click, close order, set your limit, whatever you'd like to sell it, good till cancel day, however many contracts you'd like to. You could do a market if you wanted, stop limit, whatever you'd like. Right click and close. That's how I would recommend. Otherwise, you might accidentally walk into selling a contract if you have the money in your account for it. So that covers the last 2 points for how to trade them. And then section 3, principles to remember. I'll try to keep this a tight section, but we'll talk about first the type 5. Type 5 for me is SPY, Twitter, Tesla, Riot, and Space, or I call them Spice Girls. These are just the type 5. What it should be is 5 securities that you're consistently looking at. Maybe they're the top 5 on your watch list. So you're becoming more and more familiar with them and how they move, why they move, what makes them move, things of that nature. So you're becoming more intimate with them so you better understand them, the way that their contracts work on certain days as the week goes on. However, a lot of things are going to be the same across the board, but there are nuances, or there are very finite details from security to security that a lot of people won't pick up on unless they're intimate with them. So pick 5 stocks that you like, options that are within your price range, and start learning those and start becoming familiar with them. Maybe you already have a chart ready. Here I've got mine already ready for SPY. I've already got mine set for Tesla here. I've already got mine set for Twitter here. We're ready to go. We're ready to start trading as soon as I pull that chart up from a TA standpoint. But anyways, we'll get into the next point. 90% of options expire useless. This is a massively misunderstood concept. Just for instance, we'll look at our F-cell position again here. F-cell, which I got it for the purpose of this video, I got the $10 call. Now, it doesn't need to hit $10 for me to be able to get out of my position or for me to make money or anything. I can get out of this position whenever I wanted to during the regular market. If it's called playing the premium. So you're buying the premium. I paid 0.05. So I would want to, say make 20%, which my goal would be to sell at 0.06. Yay, a $1 profit. But, for a small account, if we were doing a small account challenge, that would really start to add up. If you're talking about, maybe we did 10 of these in a day, 20% returns are nothing to sneeze at. And, but that's not the point. The point is that you don't have to be in the money to close your position. 90%, over 90% of options contracts expire useless. Most people play options just for the premium. Keep that in mind. 5-to-1 ratio. This is to mitigate your expectations. For every 5 winners, expect to have a loser. It's okay. It's really not that big of a deal. As long as you have, whether it's a stop loss trigger or a mental, and you're monitoring your position, know that for every 5 winners, you're probably going to have a loser, and that's okay. You always want to do the best you can to hedge that. But using that type of ratio, you will be successful regardless, especially if you're following like risk mitigation steps like we talk about in our university classes on our website. You'll be successful, but just know that not every trade you get into will win, but it's up to you to manage it appropriately and not get greedy. How to work a small account. So let's say we started with a $100 account, and we'll divide that by 5. We'll get $20 increments, and we'll throw 5 plays out at $20 a piece for that day. Maybe we'll net back, some win, some lose. We averaged 20% across the board. It was an excellent day. The next day, we're starting with $120. So now we'll cast out 6 positions at $20 a piece. Maybe have another great day like that. Maybe we won't. That's just the kind of principle or the kind of mindset you can have for working a small account like that. Using the 5-to-1 ratio, that you can actually see exactly how that would work and break down. Something to keep in mind though, when you are working a small account, is at some point you will need to scale, or want to consider scaling. So say we went from $100 to $200, using the $20 segments, where we're throwing $20 plays out. Now let's think about doing, instead of 10 $20 plays, we're doing 5 $40 plays. So it's gonna be the same mental or actual stop losses that you have. You're gonna be looking for the same percentages that you were looking for before for your average returns, and that's just scaling, and that's working a small account. And then with Webull, again, this cash settles overnight, so you're not having to wait for anything, and there's no PDT rules, so it's a pretty beautiful thing. Do's and don'ts, last section for the video. Do's and don'ts of options trading. Do not buy options under earnings. It is a very big no-no. Unless you know what you're doing 100%, just don't do it. It's just don't do it. Volatility is too crazy. It's a flip of a coin, but you're asking that coin sometimes to do a lot more than just land on one side. You're asking it to land like this, and of course, do paper trading when you're options trading or learning how to do options trading, or developing a new strategy. Do paper trading, whether it's learning a new strat, like I said, or you're starting out with Selene Algo or whatever. Always test in a safe environment. And for a lot of people who do have bigger accounts, who are thinking about doing options trading, which is a high majority of people watching this video, most of you guys are already trading stocks and you're wanting to develop yourselves into option traders. Just think about maybe 5 to 10% of your portfolio, starting with that, or ever using that for options trading. And that would be my recommendations moving forward, guys. I hope you enjoyed this video. If you would like to learn some more about the Trading Collective, feel free to check our website out. Link in the description. We have a short series video playlist that's going to be following this. And then if you guys wouldn't mind smashing that like button or subscribing, we greatly appreciate it. We'll see you in the next one. If you have any questions, drop a comment, or feel free to join our Discord and join us in our live streams. Take care, guys. Bye.